Hello friends, welcome to this class. Today we are going to discuss technical analysis of the stock. Now you just tell me, do you wonder about this image which is taken from the stock market? You get confused while reading this type of chart and you are not able to decide what to do with this type of image. But you want to invest in the stock market. This is the video for you if you are really interested in understanding technical analysis of the stocks and decide when to buy and when to sell the stocks and make a profit out of it. So let's try to understand what technical analysis is. Technical analysis is a process of identifying trend reversals to formulate buying and selling strategy. It is done by observing the relationship between price and volume and demand and supply for the overall market. Main tools are trends, chart patterns, and indicators. Technical analysis is on certain assumptions. These assumptions are market price of the stock is determined by the demand and supply forces. Market discounts everything. It means whatever happens in the economy, its impact is reflected in the stock prices. The market moves in a particular trend. The important notion of the technical analysis is history repeats itself, and it is also true to the stock market. It means that whatever pattern has been formed in the past, it will be again repeated in the future. So by observing that pattern, you can make a buy or sell decision. Technical analysis is basically based on the Dow theory, and it is very important to understand the Dow theory. Dow theory is also based upon certain hypotheses. Number one, no single individual or buyer can influence the trend of the market. Market discounts everything. We have already mentioned this, and this theory is not to beat market, rather to understand it. It means that by understanding and knowing about this theory doesn't mean you can make huge profits in the stock market. Rather, this simply means that you can understand the market pattern in a better way. Now, according to the Dow theory, there are three types of trend patterns. One is primary, secondary, and minor trends. So let us discuss what is primary trend. Primary trend may be either increasing trend or decreasing trend in long run. When the market exhibits an increasing trend, it is called as bull market, and when the market exhibits a decreasing trend, it is called as bear market. Here you can see this is the bull market, and you can observe three peaks, T1, T2 and T3, which are higher than the previous peaks. So this is giving you a signal of increasing trend. There is bear market, where again there are three peaks, T1, T2 and T3. These peaks are lower than the previous peaks. So this is giving us a signal of bear market. There is a secondary trend. Secondary trend moves against the main trend and it leads to the correction. The correction could be 30% to 66% of earlier fall or increase. You can see these are the secondary trends, and here also this is a secondary trend, and compared to the time taken for the primary trend, secondary trend is swift and quick. There is a minor trend. Minor trend is the tertiary move, which is called as the random move of the stock price. It is nothing but simply the daily price fluctuation of the stocks. Minor trends try to correct the secondary trend movement, and it is not of very much interest to the investors. There is a support and resistance level as well. Support and resistance levels are the levels beyond which the share price is not expected to move. Support level is level of the price where the stock price does not fall beyond that level. On the other hand, the resistance level is the level beyond which the rise in the share price is not expected. So support level, they give you the buy signal, and resistance level, they give you the sell signal. Now, there are different charting styles in technical analysis. Popular charting styles are point and figure chart, line chart, bar chart, and candlestick chart patterns. Let us understand what are the bar charts. Bar chart is simple line connecting two dots, one representing the highest price, second representing the lowest price on the particular day. Horizontal marks are drawn to mark the opening and closing prices. Now how this chart is drawn? This is the bar chart. Candlestick chart pattern is very popular, and this is also called as Japanese candlestick chart pattern, wherein there is a candle having a main body and the wicks, upper wick and lower wick. So the candles can be of two colors, one green candle and red candle. Green candle signifies there is rise in the price during the day. Opening price is mentioned at the lower part of the candle. The closing price is mentioned at the upper part of the candle. And this happens reverse in decreasing trend. This is called as bearish candlestick, where the opening price is at the upper part of the candle and closing price is at the lower part. The highest and lowest values are denoted by the upper and lower wick of the candle in both the cases. Now this is the chart pattern which you can see is made using the Japanese candlesticks. There can be different chart patterns to make the buying and selling decisions. One is V formation, double top and double bottom, head and shoulders, up and handle, triangle formation, and flag formation. Let us start one by one. V formation. V formation is a pattern which is formed like the English letter V. So here, if you observe bearish market for one or more days, and after that there is a V formation, so this neckline, the V formation, gives you a buy signal. Here you can buy because market is expected to move further, okay, upward direction. Similarly, after a bullish trend for one or more days, if there is a inverted V formation and neckline, this the support line, gives you the sell signal because the market is going to fall further in future. Alright, so that's how V formation is important to understand to decide when to buy and when to sell. There is a double top and double bottoms. Double top pattern resembles actually the English letter M, and double bottom resemble English letter W. So here you can see double top formation indicates the start of bear market. So here is the double top formation. There are two tops, one and the second top, and the formation of these two tops and is a neckline. So if lower of the second top crosses this neckline, this is actually sell signal, right? You can sell here. It means market is going to move in downward direction in future. But this trend should also be confirmed with other indicators. Similarly, there is a double bottom where this forms a W pattern of the English letter, and after this neckline, if this goes up, this is a buy signal. Here the investors can buy stock because the market is expected to move in upward directions. Again, these patterns should also be confirmed with the indicators. Practically this happens like this. You can see here, this is the M formation, top 1 and top 2. This is giving a neckline and this is giving a sell signal, and inverted double bottom W shape is here, and when this crosses this neckline, this is giving you a buy signal. Head and shoulder. Head and shoulders are easy to identify and signals generated are reliable. Neckline is drawn by connecting two lows of the head. When stock price cuts this neckline from above, it signals a bear market. Similarly, you can see here in this is head and these are two shoulders, and when this neckline is crossed by the shoulder, then it gives a sell signal. So here this is a sell signal, but this head and shoulder should be formed after an upward trend, and this inverted head and shoulder where you can see head is formed, the pattern is like this. Okay, if this pattern follows after a downward trend and it crosses a neckline, this point, this is the buy signal. Here the investor can buy. This is buy signal, and in the previous, this is the head and shoulder. So at this point, this is sell signal. The investor should sell. Up and handle marks the beginning of bullish trend, and the formation of this trend actually takes several months or even year. Now you have to identify the formation of cup, and cup formation is the rounded bottom where the red lines indicate the handle of the cup, and if it is formed, then the breakout point is the neckline, means so the level points, this is the resistance point, and if the resistance level is reached, and this is the breakout point, and after this point the investor can buy the share price because the market is expected to move in upward direction. There are triangle formations also. Three different triangles are symmetrical triangles, ascending triangles and descending triangles. Under symmetrical triangle, this is the point where investors can buy stocks. This type of pattern must be followed by increasing trend, alright? Then only the investors should confirm that this is the buying point. In ascending triangle also, the similar pattern is followed. This pattern should be after the increasing trend in the market. Then again it gives a signal like that in descending triangle. Descending triangle should be if the market is bearish for a long period of time and descending triangle is being formed. This is giving you a sell signal. So here you can sell at this point. Flag formation is also important to note because if the flag is formed after increasing trend in the market, this is the flag, support and resistance level. So during this support and resistance level, a flag is formed. This gives you a buy signal, and because again the market is expected to move. But in the bearish market, after a bearish market, a flag is formed. This gives you a sell signal. So at this point, you can sell the stocks. Now these were some important chart patterns, but one thing you should always remember that merely the chart patterns will not give you a hint by sell stocks. The chart pattern must be confirmed by indicators and oscillators. Indicators are used to confirm the overall direction of the market. Commonly used indicators are volume of trade, short selling, breadth of market, moving averages, moving average convergence and divergence. On the other hand, oscillators are the indicators to show the momentum of the market across a reference point from one extreme to another. The momentum indicates the overbought and oversold conditions of the market, and the commonly used indicators are Bollinger Band, RSI, ROC. RSI is Relative Strength Index. ROC is the rate of change. Let's discuss these indicators. Volume of trade. Volume of trade is the amount of trades executed by the investors during bull market and the bear market. Volume of trade expands along with the bull market and it gets narrowed down in the bear market. Technical analysts use volume as an excellent method for confirming the trend. Breadth of market is nothing but it's a difference between the number of stocks whose price goes up and number of stocks whose price goes down. The cumulative index of the net difference measures the market breadth. Short selling. Short selling refers to the shares that are not owned by the investors. When demand of short sale increases, it means that market is expected to rise in future. So they may not give you the absolute pictures, but they generally show trend. Moving averages are two most popular forms of moving averages are used. One is SMA, that is simple moving average, and exponential moving average, EMA. SMA is the sum of closing prices of given amount of periods, such as 50 days in the graph, and divides by the number of periods. EMA suits the curve and giving greater weight to the most recent data points. So most commonly used moving averages are SMA of 10 days, SMA of 50 days, 100 days, 200 days, and exponential moving average of 20 days. Now here in this picture, you can see the line. This is the line of moving average. Okay, and this moving average is drawn to identify the support and resistance points. Okay, at this point, you can notice that at this resistance level, the market price is going further down. This is a sell signal, and here there is a buy signal because market is expected to move in future. So this trend is confirmed by the moving average, when to buy and when to sell. Another is moving average convergence and divergence. Moving average convergence and divergence indicates two moving averages for the stock. Typically, it is taken as 12 and 16 period EMA as it is taken in this chart. The difference found from subtracting 26 exponential moving average and 12 period exponential moving average is called as MACD line. and there is a signal line which is generally drawn by taking 9-period moving average, exponential moving average. Now where is the buy signal and where is the sell signal? So here the blue line is the MACD line and red line is the signal line. Okay. So now if this blue line crosses the signal line from above, it gives a sell signal. Alright. And when this blue line crosses the red line from below, here you can see here this is the buy signal. And this is also a sell signal. You see this crosses in the overbought region. Okay. Histogram is also included in the MACD plot to make it easier to see how much the two lines are diverging when convergence takes place. Bollinger Band oscillator, which gives you the movement of the stock prices within a band. Bollinger Band are made by taking moving averages, 20 simple moving averages as recommended by John Bollinger and the most popular one, and placing two lines, two standard deviations above and below the moving averages. Bollinger Band is made by taking moving average, normally 20 days, 20 periods simple moving average, and placing these lines two standard deviations above and below the moving average. So whenever a band is touched, it serves an indicator that the security is overextended and will reverse. So here, as you can see, this chart, this line indicates the +2 standard deviation and the lower line indicates -2 standard deviation, and this small dotted line, it indicates the 20 days simple moving average. When this band gets narrowed down, it is expected that the trend is going to be reversed. Normally, very few closing prices should be above the upper band and lower band. Majority of the prices should be within this band. Relative strength index. Relative strength index is an oscillator which gives you confirmatory signal of buying and selling the stocks. It was developed by Wells Wilder. It identifies the inherent technical strength and weakness of a particular stock. It can be calculated by using this formula 100 minus 100 divided by 1 plus RS, where RS is average, the ratio of average gain per day to the average loss per day. If the share price is falling and RSI is rising, a divergence is said to have occurred. Divergence indicates a turning point in the market. Now this is the buy signal when the RSI crosses the oversold line, and this is the sell signal when RSI is crossing the overbought line. Okay, so these are two signals, buy and signals given by RSI. Rate of change is another oscillator which measures the rate of change between the current price and the price n number of days ago. RSI helps in finding out overbought and oversold positions of the stocks. This line is the ROC line. This ROC line gives you a signal when to buy or when to sell. When ROC reaches historical value in overbought region, this ROC is reaching historic value in overbought area. This is giving you a sell signal, and when ROC is reaching the historic value in oversold area, this is giving you a buy signal. So here there are two signals as you can identify in the chart. Hope you have understood use of technical indicators and oscillators along with chart patterns and trends. Now let us discuss what are the key differences between technical analysis and fundamental analysis. Fundamental analysts analyze the financial strength of the company, growth of the sales, earnings and profitability, whereas technical analysts mainly focus on the past history of the prices. Fundamental analysts estimate the intrinsic value of the shares by applying the various models, whereas technical analysts try to predict short-term price movements in the stock market. Fundamental analysts are of the opinion that supply and demand for the stocks depend upon the underlying factors On the other hand, technical analysts, they find that you can forecast the supply and demand by studying the price and the volume of trading. Thanks for watching.